Episode 35. 1935 saw the introduction of the Social Security Act in the United States. The best athlete to wear the number 35 is Kevin Durant, and when I was 35, I had a chance to see Kevin Durant live. It was Game 5 NBA Finals, Raptors and Warriors. It was a night of dreams, tears, and a night where life experience trumped financial security because I found out later that I could have sold my 2 tickets and paid off 3 months of my mortgage. Beyond MD, episode 35, here we go! Hey everyone, and welcome back to the Beyond MD podcast. It is so true that life experience sometimes will trump short-term financial security, but that's okay because you only live once. Before the interview today, a quick message. This episode is brought to you by taxpay.ca. Taxpay.ca is a one-stop online platform where you can schedule all of your tax payments, or you can invite your accountant to the platform to schedule payments for you. This includes personal tax, payroll remittance, corporate tax, GST, and HST. You remain in control at all times and can cancel or reschedule any payments on the platform. After using the platform myself, I can say it's a breeze to use, secure, and the customer service is excellent. You can use the promo code BEYONDMD, that's BEYONDMD, on the pricing page of taxpay.ca, that's taxpay.ca, to get 6 months free access. You can follow the link in the show notes to see how to get started. Simplify your life, eliminate the stress of tax, and avoid late penalties so you can enjoy the more important things. Very excited for my interview today with Mark Halpern, who is CEO of wealthinsurance.com. We discuss tax-efficient philanthropy. Now, before we dive into the interview, a few quick notes. We do talk about the RRSP, and I want to make it very clear that myself and my guest, we are not against the RRSP. I have an RRSP myself. There are statements like a $2 million RRSP may potentially only be worth $920,000. That is true if the RRSP is passed on to the next generation at the top marginal rate, or if you're pulling all the money from the RRSP in retirement at the top marginal rate. But we do know that if planning is done, and if you are pulling money at a lower marginal rate, then you will not necessarily be paying that top tax rate. I also want to make it very clear there is no sales pitch for permanent life insurance policies. These do come up in the interview, but they are simply brought up as a strategy to potentially mitigate tax when being charitable. And examples used in the podcast may have some very high dollar figures. The key is not to focus on those dollar figure amounts, but to understand those examples and extract information from those examples as it may pertain to you. As always, please do your own due diligence. So my guest today is Mark Halpern, who is a certified financial planner, trust and estate practitioner, master financial advisor, philanthropy, and he has helped business owners, entrepreneurs, professionals, and affluent families for more than 30 years. As CEO of wealthinsurance.com, Mark and his team specialize in tax-advantaged insurance solutions to protect families, create charitable legacies, and preserve estates. Mark works very closely with clients' accountants, lawyers, insurance, and investment professionals to provide comprehensive estate planning solutions. Mark is widely known for his philanthropic activities. Mark is a trustee and former chair of the Professional Advisory Committee at the Jewish Foundation of Greater Toronto, a member of the Professional Advisors Council at Sick Kids Foundation, Promise Legacy Council at St. Joseph's Hospital Foundation, Professional Advisor Task Force at St. Michael's Hospital Foundation, and chair of Professional Advisors Council at Humber River Hospital Foundation. Now, what I'm mentioning here is simply the tip of the iceberg for Mark. More details are in the show notes. Mark is also a faculty member and has contributed curriculum content for the groundbreaking Master Financial Advisor Philanthropy designation. He is building a national community of 100 financial professionals and charities with a goal of creating $1 billion of philanthropy annually. And without further delay, here's my interview with Mark Halpern. So Mark, welcome to the podcast. Where are you today? Where does the podcast find you?
I'm in my office. I'm in Markham at 404 and Highway 7. I'm in one of my small boardrooms.
Amazing. And welcome back from the holidays. I hope the Jewish holidays were well for you. How'd it go?
Yeah, it was really beautiful. It's kind of like a frozen period of time to just be with family, to focus on what's really important, really looking at gratitude for so much that we have to be grateful for. If we spend far too much time on sort of scrolling through news feeds, we'll see that the world's miserable and terrible and it's disastrous and we're all going to be dying soon. So it's nice to think positively. I think there's a lot of good things going on in the world.
Yeah, absolutely. And Mark, I have to say again, what I love about your culture is you you always prioritize the holidays. You always prioritize being together being together with your family and being there for one another. And I think that's honestly, that's one of the things I most respect about the Jewish culture. I work at North York General, so I work alongside a lot of my colleagues who celebrate the same days as you, but I think it's a beautiful thing.
Yeah, I think that's also it's actually going to be a good segue because I think that a lot of that, religious upbringing plays a lot in what I do around philanthropy and helping people create legacies and going from success to significance and all that good stuff.
Absolutely. So when I read about you and your company, Mark, I see three key words that come up. So philanthropy, tax, and insurance. Maybe just talk to us about what your company does and how did all of this, especially philanthropy, become such an important part of your path?
Yeah, thank you. So I think I started professionally November 1991, but my real start in my profession was actually in March of 1974. And that's when my father of blessed memory died of a massive heart attack at the age of 50. Yeah, I was 11.
Geez.
I was the youngest of four boys, and my mother, who was 48 at the time, had to go back to work to support our family. Why was that? My father was a busy engineer, a professional, and unfortunately there wasn't a will. There was very little savings, and there was no life insurance. So it was very hard for us. Fortunately, we all developed a struggle muscle and became very successful professionally. But fast forward, I work with some of the most successful business owners and medical professionals and affluent families, and you'd think they'd have everything all organized and together. But I'd sort of suggest 80% of the time it's not true. They're so busy looking after everything and everyone else that they don't have basic things in place. So what we do is three things. We do estate planning, which is really making sure that people's financial architecture actually matches up with the financial furniture that they have. So that would be very holistic: wills, powers of attorney, structures, insurance, etc. The second area that we're involved with is tax minimization, or showing clients how they can keep their taxes for themselves and preserve their money, as opposed to, sort of just let it slip away without any real thought. And then the third area that we're involved with is philanthropy. And that's really helping people create legacies, often by just converting taxes into charity. And that's really the area that's taken off for us, where we've become very, very well known across the country.
Thank you for sharing that story about your family, Mark, because I could tell from that obviously brought you all together. You learned a lot from that, and it's going to pave the path forward today. I know philanthropy is really a cornerstone of what you do. Maybe just broadly talk to us about why would somebody choose to be philanthropic? I think there's sometimes the more obvious reasons, but what are the reasons that people pursue philanthropy, generally speaking?
Well, I kind of see, from our experience, we've seen that there are five kinds of people that we see.
Mm-hmm.
Some people want to give because, they have a desire to have their name, be propagated past their death, right? In other words, they want their name on a building or on a chair or a scholarship or some kind. Some people want to give because they want to encourage other people to give. So they're really, you see those examples, they're really the ambassadors of this. Some people give because it's great for tax purposes. That's, partially what we're going to be speaking about, and that is the statistics say that 2/3 of giving is based on people's passions for charity, and only 13% is based on tax. So it's not the tax tail wagging the dog. So if you can combine the passion with the tax, that's great. And then there are some people who give and they don't want their name anywhere at all. Don't put my name anywhere. If you do, I'll stop giving to you. And then the fifth one is really the one who gives because they know it's good for business. It's great to be philanthropic for people. If they have a choice of who they're doing business with, they want to do business with people who give back. And really, there are two kinds of people. There are either people who just give because it's part of their education. Could be from their church, from their synagogue, from their grandparents. Their DNA is about giving. They had examples along the way. And then there are those people who don't. I've met people who are, making $15 million a year and give $300 a year to charity. It's so, and those people don't because they didn't have the education. But when those people realize they have a choice where their taxes go, that they can give them to the government or give them to charity. Suddenly they become what we call accidental philanthropists. And now they want to give. And the people who are already giving can now give more for the same amount they were planning on spending, or give the same amount for less cost. So it really just requires attention and having somebody to help understand all these different parameters.
So many important points there, Mark. So I like that last one where, let's say your estate, you can pick and choose where it goes to, right? So if you have the government, family, or charity, I guess I've heard you talk about this before. If you ask most people and you can pick two of those three, most people would pick family and charity, right? So we're going to talk about that today. And also, I think all the reasons you've outlined for wanting to be philanthropic, I think at the end of the day, when you give, it's one of the fastest ways to feel good yourself and also build these practices and habits and watch and have your children see what you're doing and hopefully pass on these attributes to them too, right?
Absolutely. And just as a little asterisk, listen, taxes are important. They're a part of our society. We have to give. That's what sort of keeps all the balls in the air in our social fabric going. But I heard a great quote, which was that taxes are a reality, but nobody says that you have to leave a tip.
That's a great quote.
So if there are strategies that the government fully endorses to help Canadians be more charitable, to support the organizations that they know they're not capable of supporting on their own, then people should really be aware of these.
Let's get into some of these strategies. I thought we could start with gifting of public securities, because I think this is one that not everybody knows about, but it's one that's widely accessible to many. So maybe what I will do is I'll jump into a bit of an example that applies to me. We can bring up some numbers and then we can dive into the details. So one of my most successful investments, I invested in a company called NVIDIA. And there was a point where I had put in $5,000. That $5,000, in fact, it at one point turned into $35,000. So there was a significant capital gain. Now most of that has dwindled away. And a year ago, I was sitting there twiddling my thumbs thinking, you know what, this is only going to continue to go up. And when I look back, I thought, wow, what a fantastic opportunity for me to, in fact, at that time, 1 year ago, start my philanthropic journey. So let's just say in that case, if I'd invested $5,000, it turned into $35,000. If I donated that appreciated security to charity, how could that have benefited me? Maybe we can go through some of the numbers.
Sure. So first thing is that people have to realize that giving cash, checks, and credit cards, which is what 93% of the population gives, is the most cost and tax inefficient way of giving. Mm-hmm. Because remember, we'll take you through it. Let's say somebody wants to give away $50,000 to charity. So they have to make 100, pay taxes to have 50, to then give 50 to save $25,000 of tax. Because when they give that charitable donation of 50, assuming that they're in the highest tax bracket, they'll have a tax savings of $25,000. The government introduced back in 1997 an ability for Canadians to donate appreciated public securities. That would be stocks, ETFs, segregated funds, or mutual funds. And they say that if you donate those to charity, normally you would have a capital gain, meaning whatever you paid for them and whatever the market value is, if you were to sell those, and assuming these are non-registered assets, you would sell them. There'd be a tax on that of about 26% of the gain. So the first thing people have to realize is that they're not worth what they see on paper. I'll use the example. You mentioned $35,000. I'll have a different example. Let's say somebody bought some stock at $10,000 and it's now worth $50,000. So there's a $40,000 capital gain. If they were to sell that stock, they would pay $10,800 of capital gains taxes, which means they're really not worth $50,000. They're worth less than $40,000. But the government says if you take that stock and you donate it in kind to directly either to a charity or to a donor-advised fund or to a private foundation, you pay no capital gains taxes, and you get a charitable receipt for the full market value, which saves you taxes. So it really is incumbent on people to look at their portfolio, their non-registered portfolio, and say, where are the biggest, fattest, juiciest gains that I've had? Like ridiculous gains. Yeah. and sell and donate those to charity.
Mm.
If you love them so much, you can buy them back again. Wait 30 days, buy them back again, whatever the case might be. But donate those as opposed to giving cash checks and credit cards. It's a beautiful thing that you can do, especially at this time of year. Just coming up to the end of the year, now's the time to start looking. April, I'm going to have to pay some taxes. What are my taxes going to be in April? Can I convert those taxes into charity by making a donation today with that stock? So it's a very, very powerful way of giving.
Okay, so we talked about the capital gains being tax-free when you gift appreciated security. We also talked about the tax receipt. And my understanding is that if you were doing this through a professional corporation, then that tax-free capital gain, if you have retained earnings in the company, that flows through the capital dividend account into your personal hands, right?
Yes, as a matter of fact, it's great to give personally, but if you happen to have investments in an investco, holdco, professional corporation where you have these gains as well, there's actually an added bonus. So yes, if you donate them, it's a deduction to the company. So it reduces the taxable value of the company, which is great for some planning if you're planning on, doing some sort of a sale, etc. So it reduces that. So it's a deduction. You get a full charitable receipt, for the full amount because it's a deduction. But the icing on the cake is that the gains, in this case, remember that $50,000 example where it cost $10,000? Those $40,000 of capital gains would be credited to the capital dividend account, the CDA, and could then come out of your professional corporation tax-free. So getting $40,000 out tax-free would normally cost you $20,000, and now you're getting $40,000. So it's almost like TOSI. It's almost like the tax on shared and split income. It's kind of like a way to get money out to family members as well, and it's lovely. And if you do have a large portfolio, there's even another layer where you could go ahead and do something like that, and then maybe use corporate-owned life insurance to replace the money that you donated to charity. Again, using some sort of insurance inside your professional corporation for pennies on the dollars to get back the money that you donated to the charity. Of course, it's a timing issue until your family gets the money back, but it's a really, really nice way of moving the shells around.
Amazing. We're going to talk about life insurance shortly. Now, just to wrap up this strategy of gifting appreciated stock, will all charities accept this method, or is it only larger organizations?
It's interesting. I work with over 60 charities. I'm on the advisory board at Sick Kids, St. Mike's, St. Joe's, TV Ontario, the Jewish Foundation. They're still really fixated on cash checks and credit cards, right? And they know that appreciated securities are a great way to go, as are legacy gifts like insurance, etc. It's just that they're very, very thin in terms of their resources of staff and people and knowledge to actually accept all of those different in-kind donations. The larger organizations, for sure, are all accepting stock. The medium-sized ones, they have ways of getting money to them through a broker, let's say, who's connected to the organization. The smaller ones, they all know about it, but maybe they haven't transacted something like that. So that's where having somebody, a resource, please, I'm a great resource. I love to help people, create these gifts. So if I can be of help to discuss that or help to navigate it, that's something I love to do.
Absolutely. And last question on this, Mark, is does this strategy work only for public shares, or can you use this strategy with private investments as well?
So that's a great question, and it's again, you're getting into opportunities here that people are not aware of. But yes, everyone knows about the donation of public securities, but people are not aware that you can actually donate private shares of a company as well, of a private company. Now it's another level. And again, as far as your medical practitioners, I don't know how appropriate it's going to be, but I'll give you a scenario, just a very easy scenario. It's very typical planning that when a business owner builds a business, at some point in time, they'll do something called an estate freeze. An estate freeze is they'll freeze the value of the company for tax purposes, and they'll pass along the continued growth in that business through, let's say, a trust, which is now owned by children or the spouse. So now they're freezing their tax obligations, and now the future growth is going into a trust that's going to be now attributed to each of those family members. And there's lifetime capital gains exemptions. We won't get into that. But that individual who's now frozen their shares has a taxable value attached to those frozen values, right? So most of the time they might use something called a wasting freeze to reduce it. But I'll give you an example. I have a fellow who they did a freeze at $28 million. The tax bill was $7. Call it a day. $28 million value, $7 million tax bill. They were asked if they were philanthropic, would they consider it? And yes, they were. So another advisor brought this to me. We changed that $7 million of tax into a $14 million charitable donation. The tax bill got reduced from $7 million to $500,000. And the icing on the cake is we created a $6 million tax-free dividend for the next generation. And we did that all through insurance and planning and all that. So a long answer to your question is, in the right situations, yes, you can donate private company shares, and it's something to discuss either with us or speak to your accountant.
Mark, great suggestions for further podcast episodes. There's a lot to dive into. Okay, maybe we can move on to RRSPs and RIFs, and maybe you could just talk to us about things broadly speaking. I think most people, well, maybe not most, but I hope most will know that there is a spousal rollover. But if you don't have a spouse, you can be stuck in a difficult situation. Maybe talk to us about this a little bit.
Sure. Again, our accountants tell us stash money away into RSPs, right? Because there's this nice deferral. You save taxes today. And you're deferring taxes. Eventually, your RSPs and RIFs are going to be taxable when you take them out or when you die. And if you have no spouse, there's a disposition, in which case the government will take, in Ontario, 53.53% of your registered portfolio over $220,000. So that means if somebody has $2 million in an RSP or RIF, which is not unusual, especially if they're a successful person and they've done some good investing, the first thing they have to realize is that their $2 million investment is only worth $920,000. So if somebody was interested in being philanthropic and giving money to charity, well, how nice would it be to give some of that money to charity while you're alive? One way of doing that would be, if you take money out of an RSP, you're going to be taxed on that at 53.5%, right? So there's a way to actually get money out of your RSP, have none of the tax withholding. Normally there's a 30% tax withholding on amounts over $15,000. We can eliminate that with a particular government form. And now you can donate that to charity. So you'll be taxed on it at 53%, but you'll get a charitable benefit of 50%. So it's costing you about 3.5% to move that money that were over half of it was going to the government. Now you're giving it over to charity, which is a lovely thing. That would be sort of something to think about while you're alive. Another thing that you could think about is perhaps leaving some or all of your registered assets to charity when you die. So again, if the family didn't need $920,000, remember that $2 million RSP, it's only worth $920. Let's say they have lots of other assets. They're very, very wealthy. Wouldn't it be nicer to leave the $2 million to charity and leave nothing to the government, and now have perhaps a charitable foundation or something to be able to give money in perpetuity from those registered assets? And that's all legitimate and part of the Tax Act.
My sense is that most people listening to the podcast will, in some way, shape, or form, be relying on the RRSP to fund their retirement. But I think you bring up some really valuable points. But one thing I also want to ask you about is the CPP benefits, because to me, CPP is honestly a bit more of an afterthought. Like, I know I pay myself a salary, and I know that because of that, I'm contributing to the CPP every year, but I tend not to think about that as much. So how can the CPP be used in charity?
It's a great question. I just turned 60 in April, and I'm, the earliest you can take your CPP is age 60. You can extend it till 70. And the first thing we have to realize is that wealthy people generally don't need their CPP. It works out to a couple, and a 65-year-old couple works out to about $26,000 a year. That money is taxed, it's reinvested, and it's taxed again, meaning it's not going to really move the dial on their lifestyle expense. That's the first thing they have to realize. Number two, which is even more important, is when you die, the CPP disappears as well. So it's kind of like what we call like use it or lose it. So here are four options. We came up with a strategy called CPP Philanthropy back in 2017. It actually was written up in the Globe and Mail. And we've come up with four different ways for people who are philanthropic to use their CPP to create charity. The first one would be this. They could take the CPP, the $26,000, and a 65-year-old couple could get a life insurance policy for about $1.4 million with that $26,000. If the policy is owned by a charity, right, then the $26,000 is considered a charitable donation. So you pay no taxes on your CPP, and you now have a $1.4 million gift. The second of the four options would be take the CPP, pay taxes on it, and get the $1.4 million policy, but have the beneficiary be a charity when you die. So the charity gets $1.4 million, and that will save your estate $700,000 of taxes from that receipt. The third option, which I really like, is take the CPP, get the $1.4 million policy, but make your kids the beneficiary of that, and now donate your registered assets to charity. Remember in that example I told you about the $2 million RRSP only being worth $920 to the family? Now the family's getting $1.4 million versus $920, and a charity's getting $2 million, which is great. The fourth option, which I kind of like to call the grandparent pension plan or the grandchild pension plan, is why not consider taking the CPP, getting the $1.4 million policy, and letting the beneficiary of that be your grandchildren. If that $1.4 million is eventually invested at, let's say, 5%, it will generate $70,000 a year in perpetuity for your grandchildren to use for their education, or to use for buying a home, or whatever the case might be, or to be used to give to them, to give to charity on your behalf, to save their own taxes while they're alive. And again, I think they'd remember grandpa and grandma that way. They probably, if you do it right, you could actually be, they'll probably remember great grandpa and great grandma.
That last example is a great example of how small actions can have huge implications down the road, I think. And so just one point I want to clarify. So if you're using the CPP philanthropy approach, if you're buying a permanent life insurance policy with it, so if you make the charity an owner of the policy, you're saving tax now, right? But if you're making the charity a beneficiary, then it's kind of saving taxes later for your estate. Am I understanding this correctly?
Correct. That's a very great, simple way of explaining it. Right. If the policy is owned by the charity today, you're saving taxes today vis-a-vis the premiums, which would be considered charitable donations. So you'll save tax today. But if the policy is owned by the charity, upon death, the charity will get that. If the policy is owned by you, but the beneficiary is the charity, so then your estate will benefit because your estate will get the charitable receipt with the donation of the policy.
Are there any other ways in which we can be charitable? Like, have we touched on all the ways, or is there more that we can do with life insurance?
With a lot, maybe about we have about 20 things we can do, but I know we're limited in time.
Yeah, we are.
We can certainly talk about a few different ideas if you'd like.
Yeah, maybe the top one or two kind of high yield ideas for the listeners.
So a lot of people have old life insurance policies sitting around, meaning, they took out a permanent policy when their kids were small, they had a mortgage, or they had a business, they had a shareholders agreement that was funded that doesn't exist anymore. In other words, there's a collection or a portfolio of insurance that they may no longer need. So there is a way that they could take that permanent life insurance policy, and it could even be term, which we'll talk about, but they can take that permanent insurance and they can actually get an actuarial valuation on the fair market value of that policy today, and now donate the policy to charity, receive a very large charitable receipt of anywhere between 10 and 70% of the death benefit, which will save you taxes today. And going forward, the premiums are considered charitable donations. So it's really a lovely thing. I'm dealing with something right now, just before our podcast, where it's a man who's 72 years of age, and he has some redundant insurance. It's a $2 million permanent policy that he was going to cancel, but his advisor told him that if he's charitable, and he is, because he was involved with some boards, he could donate that policy to have some tax savings today and create a legacy. So that policy, given his age, that $2 million policy has a fair market value of $600,000. So he can now donate that policy to the charity, get a $600,000 charitable receipt that saves him $300,000 of taxes. And going forward, the policy will be paid by him, or in certain situations, the charity will actually pay for the policy through a donor or through a fund that they've created to fund these donated policies. So just look around for that. You might have that. So that's one thing I think is a great way of using insurance. And another one, which I think is also very important, is that your professionals, if they are selling a practice, I mean, it's more challenging for a medical professional, right, to sell a medical practice. But let's say they're selling either some investment property or a business or a large appreciated securities portfolio. So that year that they sell that is going to be the year they have their biggest payday. It's going to be the year that they have their biggest tax to pay. But in that year, it's also the year that they can be their most charitable to mitigate those taxes. And you know, it's a larger situation, a larger transaction, but I hope it helps your listeners understand. It was a family that had $120 million of investment real estate they sold, and there's a $20 million tax. Not bad. They end up with $100 million, right? But they were asked whether they would be charitable to mitigate that tax, and they were introduced to me. So what did we do? We took 40 million of that 120 and we created a private foundation for the family that turned the $20 million of tax into $20 million of charity. And then we used life insurance to repatriate that donation back to the family through a strategy, a payment strategy that made it a cash flow neutral situation. So at the end of the day, family turned $20 million of tax into charity. They created a $40 million charitable foundation, and they got all the $40 million back to their family with a cash neutral structure. It's beautiful. Yeah. It's just, again, moving the shells around and having that sort of mindset. You know, I work with KPMG, PwC, MNP, all these great practitioners, and they do planning up until this point, just to this point with traditional things. But there's a whole shelf around the traditional planning, around tax minimization through philanthropy, that people really have to know about.
Mark, thank you for sharing this, because I could tell you I haven't learned about any of this stuff until now. And I think while the numbers that you're mentioning are quite larger than what most of my listeners will be used to, the concepts can still be applied. So I appreciate you sharing that. The last question I have on life insurance, let's say somebody is entrepreneurial, wants to grow their network and wants to meet the right people and be charitable at the same time. If somebody, let's say, is buying a permanent life insurance policy, and let's say the annual premiums on that total about $25,000. Let's say the policy down the road will be worth about $1 million. If somebody buys that policy and makes the charity the owner and the beneficiary, you're putting in about $25,000 a year, but what is that individual recognized as giving? Will they be kind of recognized today as giving, oh my goodness, extremely charitable, they put forward $1 million, or will it just be the $25,000 that they're giving today, year to year? I just want to clarify.
Yeah, previously, historically, charities would only recognize somebody when they receive cash. Mm-hmm. So therefore, a life insurance policy was a very nice thing to get, but it was until they have their cash in their hands, they're not going to necessarily give somebody the recognition. But that's not the case today. Charities will recognize a legacy gift of an insurance policy today as if they've received the money already, which is great. Okay. So I'll give you a great example. and we're really big on this idea of becoming philanthropic entrepreneurs. So if you're a professional advisor, there's ways for you to give money to charity for small costs, which again, if you're somebody who wants to be promoted and known for being philanthropic, it's a great thing. So I'll give you an example. So I had an advisor who is in his early 30s, and he was trying to really meet wealthier people to do business with, and to be sort of circulating in that sort of world. So I encouraged him and his wife to buy a $1 million permanent life insurance policy at a cost of $7,000 a year for 20 years. So it was a joint policy. And I said, who is the biggest charity in your neighborhood? So it was a hospital foundation. So he donated that $1 million policy to the hospital foundation. The $7,000 a year of cost is considered a donation. So it's costing them $3,500 a year, and it was a 20-year pay policy. So they're only paying for 20 years. So for $70,000 of net costs, they're recognized for giving $1 million today. So not only did he get the big check, of the donation being given, the sort of the whole the experience of giving that check, he also now got invited to all the major donor events. So those are for people who are actually writing checks every year for $100,000 a year, and those are the people he wants to meet with. And then not only that, they wrote him up in the journal, in the medical journal or the newsletter, and he's now the co-chair of the Young President's Council. Wow. So and I just want to one more example. I think that's very important for your medical professionals. So I was working with a cardiologist at South Lake Hospital. He was also involved with Mackenzie Hospital. And we did a whole bunch of work, and he realized he had some redundant insurance that he no longer needed. It was in his professional corporation, and he was going to cancel it. So what did we do? We ended up making the beneficiary of that 4 different beneficiaries, including South Lake. South Lake wrote him up in their newsletter as the cardiologist with heart, where he gave, it was $1 million, but it was $250,000 was going to South Lake. And again, it went from let's cancel this, I don't need it, to suddenly him becoming recognized as a philanthropist. Wow. And again, it was a beautiful success story, and he was recognized also by the other organizations that he gave to as well. So really, insurance is a great way of maximizing the impact on what you're doing, but at a minimum cost. So if you can work it through your planning and your strategy, it can be very, very effective.
Mark, this is fascinating. Last question I want to ask for this part of the talk is the charitable receipts. How far forward into the future can they be carried?
Yeah, it's a very important question. I wanted to talk about that right at the beginning. So first thing that people have to realize is that charitable donations in any given year can be used to offset up to 75% of net taxes payable. So if you want to give money to charity in any given year, up to 75%, of those donations, 75% of your net taxes payable can be offset by charitable donations. And any amount over the 75% can be carried forward for up to 5 years. Okay. So that means if somebody has a tax bill this coming April of, let's say, $10,000, right? If they gave $20,000 to charity, that would offset $10,000 of tax, but you can only use it to offset up to 75%. So therefore, they could save $75,000, $7,500 of taxes this year, and the amount over that, the other $2,500, could be carried forward for up to 5 years. The thing that people don't realize is that in the year of death, charitable receipts can be used to mitigate up to 100% of estate taxes, and you can go back the prior year as well to use that on the previous tax return. That means, just think of it, if somebody has a tax bill, an estate tax bill of $1 million, and they've done the planning to see that. And now they buy a $2 million life insurance policy for pennies on the dollar and make the beneficiary of that a charity. Upon death, the charity is going to get $2 million, and that's going to save the individual $1 million of tax. And now that $1 million of tax became $1 million of charity, all by using insurance and by doing planning. So my dream really would be that this is part of everybody's estate planning, that they've done the planning to see what's their ultimate, sort of estate tax liability. And now let's build in a whole philanthropic model, again, using insurance or other strategies to turn those taxes into charitable legacies for children and grandchildren in perpetuity.
Mark, so many amazing nuggets of information in what you just said. This is honestly one of those episodes where, as you can see, I'm just kind of shutting my mouth and listening because there's a lot to take in. Yeah.
I didn't know that. I didn't know if you speak a lot. I don't mind. You can, I'll take I'll take some time off also.
Mark, I just want to thank you for being so generous with your time and being so passionate about educating people on these topics, because I can tell you this material is under discussed. We are rarely, if ever, exposed to it, and I think it's just a very important part of the toolkit. Like you mentioned, most people will advise and guide to a certain level, but I think this kind of goes above and beyond. I want to thank you. I want to thank you for taking the time.
Really my pleasure. And thank you so much for reaching out, and look forward to doing more together to really educate people and provide them with wisdom and knowledge that they need in a very frenetic world to help them make decisions that are important for themselves and their families.
Absolutely. Absolutely, Mark. Thanks again. So remember, for every $2 donated to charity, you will save $1 of tax. And remember the triple benefit of donating appreciated securities in kind from your corporation to charity. You get the capital gains tax-free, you get a tax receipt, and you get an amount equivalent to the capital gains flowing from your retained corporate earnings through the capital dividend account into your personal hands. Reach out anytime, beyondmdpodcast@gmail.com. You can connect with me or follow me on LinkedIn and Instagram. I'm always so grateful for reviews, ratings, and people sharing the podcast with their network. And until next time, stay well and stay savvy.